Hi everyone. Today we have Nevin Freeman with us, the co-founder of Reserve Protocol and the man who called out UST and Terra Luna model back in December of 2019, live on stage. And here's a clip of what he said back then.
I think that the biggest risk, the thing that could go really massively awry with stablecoins that could be terrible for the crypto world overall, is if there's an algorithmic stablecoin that has no backing, that just has a sort of algorithmic mechanism that's meant to keep it stable, which we tried really hard to figure out one that would work in it.
Stable relative to?
You know, whatever their oracles are pinging the price of. It could be the dollar, or the euro, or gold, or what have you. But there's a category called algorithmic stablecoins. I would put Terra and Celo in this category. There are a number of others. Basis was like this, and they never launched. The thing that could happen is one of those could launch and be marketed very effectively and be significantly adopted. It could even happen in a market where people really, really need a stable currency and don't have one, and that's why it gets massively adopted. People who are not crypto speculators, people who just want to preserve their savings. If that protocol then blows up economically and falls apart, and the price of that goes, down half or close to zero, regulatory backlash. Imagine if we were sitting here today talking about how great our stablecoins were, where it had already been the case that like $1 billion stablecoin had collapsed and lots of innocent people had lost their money. It would be a very different situation. And that really could happen. There are economic experiments being run with some stablecoins that I believe personally could go that direction. And so I think the worst thing that could happen is if one of those gets really big before it fails.
Yeah, it's like they hard code economic theory into a thing, let it go, and it runs, and then...
And to be clear, Nubits and BitUSD, like BitShares, are both like some form of like algorithmic stablecoins that have collapsed. Like the peg has broken. It's just that it was a tiny number of people in crypto using them, right? But we have these bigger projects who are marketing to huge numbers of normal consumers. And so I think there's a real risk, a real thing to be worried about there.
I believe there is no way to launch uncollateralized algorithmic stablecoin.
It's happening. It's already happened.
Yes, but there is no way to get adoption. Why people will use that?
Terra will tell you that like hundreds of thousands of people in Korea are using it to like pay for like the most popular thing is diapers on an e-commerce website because they have like partnerships with people and they're offering massive discounts.
And make it die. People are using
like
it.
Ponzi schemes.
I don't want to use that term. I don't want to use that term. But so, basically paying for adoption is something that could cause this.
Okay.
Hi Nevin, so great to have you with us today.
Yeah, thanks for having me. It's great to meet you.
So awesome to see you as well. Can you explain, what do you think what actually went wrong with Luna and UST?
Yeah, so here's a metaphor that I think helps make it clear. Okay, so imagine if you went to a bank and you deposited your money in the bank. And then once the bank had your money, instead of holding it for you, or instead of lending it out to other customers of the bank, they instead turned around and took your money and distributed it as a dividend to all of the bank's shareholders immediately. Okay, so the bank shareholders have just gotten more money, but the bank doesn't have your money anymore in any meaningful sense. And then later, if you go to the bank and you say, I'd like to withdraw my deposit, they have to call up the shareholders and be like, hey, we need some money because, we actually have to pay back this deposit that someone made. And the shareholders have to come and pay back the money if they choose to, and then the bank can turn around and allow you to take your money out of the bank. Well, now imagine that the depositors don't have any contract that requires them to do that, right? So they can just choose, do we want to pay back this money in order to help people withdraw from the system or not, right? So if you imagine you're a shareholder of that bank, but it's fully voluntary, as long as more people are depositing than are withdrawing, it's like, okay, I got $1,000 today and I only needed to pay up $10. This was a good deal today, right? As long as it's always, 1,000 in to you and only 10 out, you're like, this is great. I love being a shareholder of this bank. But now imagine a day comes where people only deposited a little bit and they wanted to withdraw a bunch. So all of a sudden you're being asked to pay out way more than you're getting as that shareholder. Well, all of a sudden you don't like that anymore, right? You're like, this isn't so fun anymore, and it kind of seems like this is going to keep happening. So, I think my days of being a shareholder for this bank are over. I'm just going to peace out and keep all this money that I got, and not help the bank pay people back. And that's basically what happens with, that's basically the way, that's kind of like a metaphorical way to describe how a senior shares algorithmic stablecoin works. And that's what Terra Luna is based on, is this design of senior shares. It's a little bit different because the tokens are burned and minted and so on, instead of just paying out as a dividend. But economically, it's basically like that. And so that's basically what happened with Terra, is we reached a point where all of a sudden something caused a lot of the stablecoin holders to panic and to want to redeem their money. And when the shareholders sort of pieced out, that was basically everybody selling Luna. They're like, okay, this has been a good ride. I'm going to sell my Luna now because it looks like it's no longer going to be profitable. Lots of Luna is going to be minted, and that's going to cause Luna to crash. So I'm going to sell as soon as possible to get out. The more that people sell Luna with that in mind, the more that actually causes Luna to crash. And so it ends up being a self-reinforcing cycle. And so, back in that video, in December 2019, we didn't know when this would happen. But if you looked at the basic economics, it seemed like it had to happen eventually, right? It seemed like it was like a little bit determined that it would somehow eventually happen, because if you just think about those basic incentives, it's pretty clear what you should do as a shareholder once you reach that state.
Right. So some people are saying that had they had lock-ins for a week or 2 weeks or something, this could have been avoided. But according to you, that could have possibly delayed this reaction, but it would have eventually toppled off.
I think that's right, because people are saying, if there was a delay where, there's various different kinds of delays you can try to add to the system. And we see this happening with capital controls in nations. Capital controls often are that same kind of idea applied on a national scale of like, okay, we think people might flee the currency, so let's add a rule that says you can't flee the currency. You can only trade out a certain number of units of your currency into dollars or something else per month.
Right.
Like those laws exist in some countries, and what we see is not that people necessarily obey those laws. Instead, they find other ways to trade out, right? So it's like in say Argentina, where you can only buy, last I checked, it was like $200 a month. People don't limit themselves to that. They just go buy dollars, on a parallel market somewhere. And that actually does end up massively driving the exchange rates in those parallel markets. So the point is that, like, there's an open market for Luna and for UST and for B Luna and blah, blah, blah. So like everyone would still see that possibility could be coming, and they would do their dumping on the open market. And so you could still get the price of the stablecoin crashing, you could still get the price of the share token crashing. And so the whole thing might play out slightly more in slow motion, but actually, I mean, the Terra system actually already kind of had this capital control in place. Like you redeem a certain amount of UST per Luna per unit time, and then that liquidity would be exhausted. And that didn't really do anything to stop this. Once people saw that the thing was going to unwind, it's like, okay, the massive dilution of Luna, it's not going to happen right now, but it's going to happen over these, like, whatever it was, 36 block periods. That's enough to get people to run away. So I do not think that there's any simple change to the system without a fundamental change that would have prevented this happening in the long term.
So this applies to any algorithmic stablecoin in general, right? Like you have Frax, you have the Neutron USDT coin, you have, of course, the Terra Luna side of thing, and a bunch of other stablecoin projects just became pretty hot, I think 1.5 years ago, and there was like this trend, and kind of Luna took the ship. Like, do you think it applies universally to all of them, or like there is a way to salvage this wreckage?
Well, I think that it applies most obviously to anything that is a pure seniorish shares stablecoin, and that's the design we talked about, where basically, when you mint new stablecoins, that burns the share token, and when you want to redeem when you want to redeem, you redeem the stablecoins for newly minted share tokens, and there's no other, external backing assets. Now, there are various variations on that. So, like I cited Celo as an example in that video, and so a number of people have asked me, like, so does this mean Celo is going to collapse right now because of the panic? And the answer, like with Celo, is like, well, no, not right now, because actually you can go look at their reserves page and the way that they've managed their treasury so far, kind of like how DAO was accumulating Bitcoin, or not DAO, but, their foundation. Celo's been doing a similar thing, sort of from the beginning, and their reserves are actually worth more than their outstanding stablecoin liabilities right now. So at this moment in time, they have more than 100% asset backing. Now, if the price of Bitcoin and ETH were to go to zero, then they would have way less than 100%, and I actually think that a similar unwinding could happen. And then, with Frax, I haven't looked deeply into the details of Frax recently, so, like, I don't want to speculate too much, but, like, the basic fundamentals are that there's, according to Sam, there's, like, 89% external asset backing and 11% sort of internal, algorithmic backing, which just means, you're backing with that ability to mint the share token. And so, like, with that, I think that there is risk, right? Because, like, think about it this way. Imagine you found out right now, like, imagine I, like, credibly told you right now that USDC only had 89% backing and the rest was unbacked. Well, that's pretty high, right? That's almost 90% backing. And so it's like, well, under ordinary circumstances, 90% of USDC holders aren't all going to want to go redeem at once. It's a popular product. But that popularity depends on people trusting it, right? So if all of a sudden everyone in the world suddenly learned that there was only 89% or 90% backing, people might rush for the door, because you could see, like, well, that does seem like it might lead to a bank run, and so I better redeem, because, if I'm in the last 10% of people to try to redeem, I might get nothing. And so even if you, so if you had that 89% backing of a fiat-backed stablecoin, I think you would potentially see very quickly a bank run happen, and that coin would then go to zero at the end of that once the backing ran out. And so, with something like Frax, if it has 89% backing, and then in theory, it has the rest backed or even over collateralized by its ability to mint that share token, what we just saw happen with Luna, I think, was really informative, right? Where Luna was so big, 30 billion or something, even larger at times. And so it just felt like this is a lot of value. There's so much value there backing this. And we just saw how quickly that market cap can completely go to zero. In just like a few days, you go from 30 billion or so to effectively zero or something close to it. That kind of shows you the reflexive nature of sort of the share token in the senior share system. And so I think you have to worry about that kind of possibility with something like Frax, where it's like, well, maybe that 11%, or maybe it's even over collateralized, maybe that just goes away over the course of a day or two. And so if I was holding Frax and I saw the value of that share token all of a sudden deciding to tank, I'd be like, that's questionable. Maybe I should redeem my assets. And so I do think that there is the possibility of a bank run scenario, even for something that's kind of a combination of asset-backed and algorithmic.
Yeah, and we saw that, like, I think 2019, we had a major issue with all the liquidations and the sort of major correction with DAI as well, where, after which they integrated USDC within their backed collateral asset holdings as well. And at that point of time, I think whether it's the community of Ethereum or whatever have you, right, like Maker and DAI was able to survive and come back without too much of a pain. There was pain. The market caps of things weren't as big, and we were pretty much in a bearish scenario market as well. But sort of it didn't hurt as many people. It did quite and it did do a bit of damage to a lot of people, but wasn't as bad, and it did recover back and kind of save itself, right? Like Luna is trying to do the same, but do you think it's too big to come back to its original glory, or?
Oh, there's no way. There's no way Luna and Terra can come back. I mean, they can fork the blockchain, and they can have a new Luna, and they can have a new ecosystem. But yeah, there's no way that the current UST token can go back to $1.
Then why did DAI save itself? Why was DAI different?
An interesting thing is that in that situation, the DAI peg actually diverged upward. It actually, DAI was worth $1 and like 2 cents, I think, for a while until they instituted the new mechanism. I don't recall the exact specifics of what happened in that scenario, but the thing is that I think the problem with DAI at that time wasn't exactly a lack of backing. It was a lack of redeemability and a lack of sort of issuability, where normally with a pegged currency, if you can take, let's say you're pegged to the $1, if you can take $1 and convert it into one token of that currency, and you can take one token and convert it into $1, then if the price is ever above or below, there's an open arbitrage loop where you can like trade $1 for a token, then go sell the token for $1 and 2 cents, then take that $1 and 2 cents, set 2 cents aside, and go buy another token, and you've got 2 cents of free profit, and you keep running that loop until it brings the price of the token back down to $1. Same thing from the bottom. And with DAI at that time, before they updated the protocol, there really wasn't actually a way to do that. DAI wasn't actually straightforwardly issuable for $1 or redeemable for $1. Yeah. And so by adding the USDC, I think they call them vaults now, I think that they fixed that. They made it so that DAI and USDC were kind of interconvertible, and that made it so that the price of DAI is more directly pegged to the price of USDC, whereas before the peg was actually kind of a floating thing that was backed by the fact that in the event that the system was wound down entirely, then you could redeem your DAI for $1 worth of collateral. So it was kind of a looser relation.
I think there might be two different incidences that we are referring to here as well. Like I think that time there was like a major ETH correction where even DAI ended up correcting quite a bit and led to a lot of liquidations did take place, but at the same time the system couldn't recover back simultaneously. So I think there was a bit of a correction with DAI at that point of time. But yeah, we've been through that. But the numbers were nowhere as big as what happened with like UST and Luna, right? Like I think, and it didn't even happen at a point where we had this kind of an adoption and stuff. So I think it was able to correct itself. And I think protocols over time, the more trial and error they go through without reaching that critical mass, kind of become more susceptible to these kind of failures. And the earlier on, the more they go through, I think they become stronger. Before we talk more about RSR and reserve, sort of, I want to know like how is all of this, right? Like what are the different type of stable coins that you think exist, and where does CBDCs fall into this category, if at all? And sort of like you're very aware of the regulatory aspects of things. So can you enlighten us with like some more information of things that we should be knowing about these stable coins that we possibly don't know?
Yeah, in terms of, the overall categories, I think the space has ended up with a pretty good categorization. So I'll just mention that, you have the sort of coins that are 100% backed with stable assets, right? Like coins that are directly backed by dollars or by euros or by gold, and they're pegged to the thing they're backed by. So there's always full redeemability. Then you have the coins that are over collateralized with volatile assets, right? And this is like the Maker system or Liquidity, where basically that the thing you're backing it with is ETH or something else that's volatile, but you have more than 100%, and you have a liquidation system so that you can do your best to always maintain that more than 100% backing. And if you run those conservatively enough, and if the markets don't completely flash crash, then that will work forever. if you do have like a really sudden flash crash, where the value of that collateral suddenly goes, down 75%, then you would end up in an under collateralized scenario, and you would have probably an ensuing bank run, and it could be unfortunate. But they're generally much less dangerous than the algorithmic design, which we've just been talking about, sort of based on that senior shares idea, where there's no external backing. You're only backed by tokens that are intrinsic to the protocol somehow, and there you can have this negative unwinding scenario. In terms of CBDCs, they're almost certainly all going to be an instance of the first one, right? Because no government or treasury or central bank is going to support, unless, never say never, right? Like, I'm very surprised at how the president of El Salvador has behaved with respect to crypto and monetary policy. Seems a little odd to me. So maybe there'd be like kind of a rogue, maybe we're seeing like millennial president behavior in El Salvador, and maybe we'll see like Gen Z president behavior, and it'll be like, let's have an algo stablecoin. That could be crazy. Anyway, I don't think that's going to happen. So I think that CBDCs are generally going to be instances of 100% collateralized with stable assets, or just issued by a central bank, right? So it's like, if you're the Federal Reserve of the United States, and you can just create dollars and add them to the database, the central database of dollars, well then in that sense, the token that you've created, if you create a token as a central bank digital currency, it's not necessarily backed by anything. It sort of is backed by the fact that you decided that there would be a new unit of that currency in circulation. So I guess that kind of breaks the categorization system. You're kind of going to
backed by fiat. Like, it's essentially how a government would issue to a bank. It would issue to another central government-based organization, which will then be able to give people or collect money from people. Like, where CBDCs in my head sort of make sense is that you would have this app where you would have this wallet where you can get paid and stuff, transfer money at the same time, pay your taxes or whatever have you, like just making it like a cohesive system. But I think these things rarely happen and they're rarely seamless. They always make things more complicated. And sort of, would you be able to take out money from this ecosystem and put it on a, Uniswap and trade with it? Like, these are questions that don't have answers.
Yeah. So the interesting thing is that, like, it seems really unlikely that governments and central banks will issue CBDCs on public blockchains that are like fully permissionless and pseudonymous or anonymous, right? Because it seems like they generally want to surveil more and more. But that having been said, one thing to note is that if there's let's say there was a CBDC of the dollar, and even though, let's say it was like kind of on a private chain and they had full visibility or whatever, but you still actually held it with like a crypto key instead of needing to depend on a banking institution to hold it. Well, it might actually make issuance of dollar stablecoins easier, because you as a company, you could just become a custodian. You could hold the CBDC dollars yourself instead of depending on a third-party banking partner to hold the dollars or several of them. And so you can then issue like a stablecoin that's backed by the CBDC dollars on Ethereum, on Solana, on whatever other chains you want to. And so it actually might make the tokenization of currencies easier, because you don't have to deal with banks in order to run a tokenization company. So I'm not particularly excited about CBDCs in and of themselves. But it could be that if we're allowed to hold them, with public-private key pairs, then there could be a lot more tokenization, not just of the dollar, but of many different currencies around the world, and that could lead to, more baskets of currencies, more trading against different currencies.
Right. So with regards to CBDCs, I'm not able to get enough info to be able to make my mind whether I like them or not, whether I pro them, against them, because for me, it's the same as fiat, right? Like, if it is the same as fiat, then it is what it is, right? But that said, what does excite me about them coming out, and maybe that's the only thing, is that it will give people a taste of how to use a wallet, how to have a cryptocurrency in general, which is like the biggest hurdle for us to get much more adoption with Bitcoin, Ethereum, and the crypto side of things. So I felt like if everybody was used to and kind of does trust a particular wallet, then getting into Bitcoin and holding our own coins might become second nature, which it isn't right now. So that's possibly the only thing that did seem like, wow, like this might just help our cause than affect it. But yeah, I think that aside, you kind of broke down the categories into like three basic heads. One is collateral backed, which could be, stablecoin themselves backed, or volatile collateral backed, where you get a lesser amount for a higher backed asset. And then the second one was algorithmic stablecoins, and then you can have a mix of algorithmic as well as collateral backed. And the third one is CBDCs per se. So where does RSR and Reserve kind of fall into this category?
Yeah, so Reserve is kind of a combination of the first and the second. So RSV today is just backed by other dollar stablecoins. So it's definitely the first. It's 100% backed by stable assets. But in the future, we anticipate that there'll be lots of R tokens, we call them, built on the Reserve protocol, which in some cases are backed by stable assets, and other cases are backed by assets that have been lent out. So let me step back and explain what I mean by that. The Reserve protocol actually is an open platform that allows anybody to issue a basket-backed stablecoin. That's kind of like how anybody can go to Uniswap and list a new trading pair if they want to. And it works with the same technology as Uniswap, which is called a factory contract. So you can go and use the smart contract to deploy another smart contract, or actually a set of them. And anyone can do that. And when you do that, and that's how Uniswap works. So if you go make a new trading pair, you're actually deploying a new smart contract that's then just there forever. In the case of an R token, you're deploying this new set of smart contracts, which then you can define what are the assets that are going to back it. Any ERC20 tokens. This is all in Ethereum. And so one example type of R token that we expect to be popular at the beginning is a stablecoin that's backed not just by other pure stablecoins, but that's backed by other sort of stablecoin derivatives, if you will. Basically, something like CDAI, for example. And CDAI is if you take DAI and you put it in Compound to lend it out, you get back a token called CDAI. And CDAI then just grows relative to DAI because it's earning interest from Compound from having been lent out. But if you think about it, CDAI itself isn't directly stable asset backed. CDAI is actually kind of collateralized by whatever the borrowers and Compound have deposited as collateral. So let's say that that's ETH. It's kind of the simplest example. Well, now that's kind of like well, DAI is a funny example because it was already over collateralized in that way. But let's say it's CUSDC. Okay, so it's you deposited USDC in Compound, but now your CUSDC is backed by ETH or BAT or whatever other collateral assets the borrowers have deposited. And so you kind of have a system that's similar to Maker in Compound itself for these C tokens, for the tokens that you get. And so what that means is, you kind of have this combination, right? You have like the full backing for USDC, but you don't actually have the USDC, you actually have the CUSDC. And so there you are relying on the Compound mechanism, which is more like the Maker mechanism. So the point is that
you cannot take it out till you return it. So it is actually locked in the smart contract. So even if you do use that collateral as a collateral backing things, it actually stands for the money which is locked in Compound, because nobody can, you have to return the money before it can be released, right? So the maths actually balances itself out.
Yeah, that's right. So if you're a borrower from Compound, you might deposit $200 worth of ETH in order to borrow 100 USDC. And then you have to repay that 100 USDC before you can get your $200 in ETH back. And that makes it so that if you just peace out and never come back, and I'm the lender and I want my USDC back, Compound will automatically sell part of your ETH in order to repurchase that 100 USDC to make sure that I can get it back. So again, as long as there's no flash crash in ETH, then this will always work. So the point is that because the Reserve Protocol is an open platform like that, and people can create different baskets, someone could actually create a basket that some of its backing, or even all of its backing, is some algorithmic stablecoin that's super unsafe. We don't have control of that. So there's going to have to be basically information sharing and research and so on in the community for people to understand, okay, this one is safe, this one is not safe. And we're not going to stop people from creating things that are unsafe, but we're definitely not going to encourage people to use things that are unsafe. I'm sure I'll be vocal about anything that I think is a bad idea. And like the overall stablecoin ecosystem, I think what's necessary is to have some sort of rating agency, some sort of independent nonprofit entity that actually looks at different stablecoins, including our tokens, and tries to distinguish, what type is this safe, is this not safe, and sort of gives them a grade, similar to what we have in the bond markets, right? So in the bond markets, you have like the AAA rating is like the best, and it sort of goes down from there. And that's done by these independent companies like Standard & Poor's that do that research and publish those ratings for the market to consume. And so I think that that's necessary in the case of our tokens, but I think that's necessary in the case of the broader stablecoin ecosystem overall.
Interesting. So, give me a few reasons why I would like to do that. So there are a couple of ways I can create a stablecoin on reserve rights. Like if I have the C token from Compound, let's say it's CUSDC, I can deposit in an existing pool and take out a stable coin against it. Like I could literally put in CUSDC and take out RSV, right? And then I can convert that straight up into USDC and I'm ready to use that money. Why would I want to create my own stable coin? Why is that white label solution necessary for anyone?
Yeah, it's not so much that we think everyone would want their own stablecoin. It's more that we want there to be open competition amongst different design ideas, and so that's why we made it fully permissionless. So with that example of a stablecoin that's backed by those dollar derivatives, the benefit would be let's imagine that got popular, and there was a single one that got the most popular. And maybe people tried 10 or 100 different variants, but let's say just one of them gets the most popular. If you can use that on centralized exchanges and on DeFi and so on, just in place of the normal stablecoin, then it just means you're always passively earning that yield, right? So if you have a balance that you just forgot about that's sitting in your Binance account or your Coinbase account, it's just constantly ticking up a little bit. And so you're just leaving less return on the table. And if you think about it, USDC and USDT combined have, I forget the exact number, 100-something billion in combined market cap. That's a lot of capital that's just sitting there in dollars, right? Fully dollar denominated, not earning any yield. So if you imagine, if you're a market maker that has millions of dollars across exchanges, or if you're just a normal person who's trading crypto, it's nice to have that sort of passive yield that's constantly there, even when you're not thinking about it. So it's kind of like a default that's better than the current default. That's kind of the use case that we perceive for a token that's backed with those other assets instead of directly with stablecoins.
So this is sort of like a money Lego system as well, right? You take existing assets and you put it in a place where it's getting used and hence you're getting interest on it. But because you get a receipt for that, which is in CUSDC or whatever, you can put and redeploy that into more work because you own that asset and you can't take it out till you return these receipts any which way. So
yeah. And one note about that is that, exchanges already could have listed, say, CUSDC and CDI, and there's a bunch of these tokens. The problem is that there's always more and more of them. And so it's like, okay, are we going to list a zillion of these different, dollar DeFi coins? And so one thing we think is potentially valuable here is by aggregating them together into a basket and having a decentralized governance mechanism that sort of, moves capital back and forth depending on where the yield is and the safe tokens and so on, then you can consolidate that all down to a single token. that you can build liquidity and brand and so on around. And so that makes more sense for people to choose rather than having to choose one of 10 or 20 or 30 different options that are all kind of the same and you don't know how long each one's going to last and so on.
Awesome. Yeah, I can ask you so many questions now. Like, this is super interesting. Why is it faster for something like a Luna to grow than the reserve stablecoin? Like, why is there such a big market cap difference between what they reached and what yours have reached?
Yeah. Well, so, I mean, I think there's a couple differences. Obviously, there's the 20%, right? I was at a conference last week, and someone came up to me, didn't know who I was, and was just saying, are you a VC? And I was like, no, I'm not a VC. And he's like, I need money. And it's like, okay, why do you need money? All of our money was in UST. Now it's all gone. And we were like, why did you have your money in UST? And the answer was 20%, right? And it's like, well, okay, it makes sense. It makes sense. If you perceive that it's low risk, then getting that 20% is exciting. And so, but obviously we've seen that wasn't really a sustainable design. That 20% ultimately was coming from capital that was selling tokens, that were the sort of the share tokens in these systems, that you sort of have this like cyclical demand that's cyclical on the way up, and as we just saw, cyclical on the way down. So we're trying to build
linear on the way down, like it was just a straight line on the way down.
Well, right, but it was self-enforcing, right? It's like once it starts to go down, that makes it go down more. Yeah. Whereas once it started to go up, that made it go up more. I know. I'm just joking about it. Yeah, totally.
But it's painful at the same time. Like, it affects everything, right? When things like this happen, it literally brings us back 6 months to a year's time easily, right? Like the number of people that get affected and how it brings the entire sentiment of things down. Like it affects you as well. Like it affects RSR as well. It doesn't make you look stronger, because if one type of project within a particular sort of, bag fails, right, then everything comes under the same kind of lack of interest for a while, right? Like, but then there are things like Tron is giving 30% with their USDD coin that they released, I think, a couple of months back. And I thought that system was very similar to Luna and UST as well. It seemed extremely similar, but I don't know too much about that.
Yeah, totally. Yeah. And then another factor that's caused RSV to stay small so far is that we just felt that a purely dollar basket stablecoin wasn't actually interesting or meaningful to crypto speculators. It's like, why use that rather than USDC? Yeah. Well, there's not really any good reason to. So we didn't focus on marketing it to the crypto space. Instead, we focused on building the Reserve app, which is a completely different ecosystem, focused on people in countries that actually have currency issues that are really interested in getting access to stablecoins. So we use that as a building block to build that platform and to build a user base in those countries. And from that perspective, it's gone really well, right? We have about 600,000 users at this point doing over $100 million of transaction volume per month in ordinary everyday transactions, not buying and selling crypto, just buying, and selling, milk and mechanic services and everything under the sun. Right. We see like an entire cross-section of the economy in Venezuela in particular, where there's tons of payroll happening and tons of people ordering food and delivery apps and so on with a dollar stablecoin, which we're super excited about. But the numbers are much smaller because you get these sort of billions of daily volume in crypto speculation that you don't quite have in the normal economy in a country like that. So I think it could be a turning point with launching the protocol, because now with yield-bearing stablecoins that are safe, that are well thought out, right. If the market wants that, they could get really big in crypto. In the speculation sphere, they could be listed on many exchanges. It might be a pretty different story from our current RSV, but it's really up to the market. We won't know for sure until that's live, until those stablecoins start to be created, and then we see what the demand is like.
Awesome. So before we move to our last question, sort of the most fun question I usually ask, I want to know like what exciting thing is happening at your end for the next 6 months to 2 years time. Like what do we expect from your project and yourself? Like what's exciting you the most for the next 6 months to 2 years time?
Totally. Well, on the app side of things, our team is working on expanding throughout all of Latin America now, actually much more rapidly than we did with our initial countries as we got things going. So on the app side, that's super cool. There's a lot of different features they're going to be adding to the app, and I think it could be pretty exciting, going beyond the initial use case to a broad financial product. Obviously, the launch of the reserve protocol, if you follow the project, you know what that means, but basically everything we've just been discussing has been in development for quite some time, longer than we thought, but we're getting close to actually launching that. And so I'm super, super excited to get to this point where we have this open platform and we're getting to experiment and letting everybody else experiment with creating these different stablecoins to see what people come up with. It might be that we're surprised by what people come up with. I think that, over the next 1 to 2 years, one major challenge that we're aiming to tackle is decentralized governance, because the state of the art in decentralized governance is not good enough. I actually worry about collapses happening, where lots of capital is stolen, or really bad decisions get made over the next several years in crypto with the current token voting system that a lot of projects are using. Because once the tokens that are held by insiders and VCs and so on get sold and distributed, which will happen over the course of time, right? It's like VCs aren't going to hold the compound token for 10 or 20 years. Eventually, they're going to cash out and move on. The systems start to become more vulnerable. And I won't go into details right now, but it's something worth worrying about. So our team is investing heavily in decentralized governance research. And this will be done in public. This will be a community effort as well. It's not just us, we'll be sharing the core team's thoughts and, leading other people in doing that research together. And if we can actually figure out sustainable and effective decentralized governance systems for our tokens, those might apply to many different protocols in the crypto world. And I think that that's like a night and day difference for the future of crypto. If we really generally fail to solve that problem in this space, then a lot of the stuff we're dreaming about isn't really going to pan out. But if we can really solve that, it just opens the door to like the thing that we're all kind of dreaming about, of really having these systems that are, not co-opted by, a single government or a single company or whatever, where you can kind of trust the process and really see what is the process trying to do, and sort of see and trust that things are going to turn out the way that you want them to turn out, in a sort of less politicized way. And that would just be fabulous if we can make that happen.
Yeah, I think that's such an important point to kind of keep in mind, right? Like there are no standardized best practices for any DAO ecosystem to come about. And what we're seeing right now, whether it's gaming, whether it's DeFi, and mostly DAO, right? Like we're seeing people's ideas kind of be there, and they're not the best practices. And I think when you guys research and kind of be able to find out like how psychology or mathematics or economics or, trends fall into, everything is observed kind of leads to a good governance model. And I think that'll be pretty cool as well. So there you have guys, like the guy who called out Luna UST back in December 2019 is calling on the current governance model and asking you to be aware of it. So with that, Nevin, this is my last question. Tell me your favorite altcoins and which projects do you like the most in the crypto space?
Oh, that's a good one. When running a project, you don't have as much time to really look into everything. So I'm really a bad person to ask that question to, mm-hmm. but I will tell you a couple projects that I personally think are really awesome. One is MobileCoin. MobileCoin is a cryptocurrency that it's kind of a cross between Stellar and Monero. So it's really fast and cheap, but it's also fully private. And it's already integrated into Signal, the messaging app. So like you can go to Signal and turn on the payments beta, and you can send MobileCoin back and forth between people. And so they really made a lot of progress toward very practical, payment coin, where you could use that. And I think it needs to be stable to really go mainstream. But I think it's a super cool project worth looking at. And then the other one that I'm kind of a fanboy of personally is called Urbit. And Urbit is even harder to describe, but the basic idea behind Urbit, it's actually crazy. This project started back in 2002, and they've been super patiently building since 2002. Like they literally invented a new programming language from the ground up, like the assembly language and then the programming language, and then they built an operating system and services on top of it. And what it's meant to do is to make it so that everybody has their own personal server. Instead of you running applications on just as a client with like a big server behind it from a company like Facebook or something, it's a completely different architecture for web applications. Where everybody has their own server, and then all the servers talk to each other peer-to-peer. So as a developer, you can write software and send it out to people, and people can install it, and then it runs in this peer-to-peer way that's like a fundamentally different architecture. And there's a bunch of reasons for why they think that could be cool. I think it could be cool too. I think it's still too early to tell, if the project's really going to work and get big and be mainstream. But it's a super fascinating project. I love the people behind it as well. Same with MobileCoin. Great people behind both of those projects. Both are working really earnestly to build something that the world probably needs. So I'm excited about them both.
That sounds awesome. I did not know about the Signal thing with MobileCoin. And I think I have studied a bunch of things with MobileCoin. I think they have a cool SDK for people to build stuff on as well. But any chance that we will see RSR sort of be integrated as the stablecoin along with MobileCoin on Signal?
Who knows?
Awesome. Yeah. So it was so nice to talk to you. This was really refreshing, and I thought I learned a lot today in today's conversation, and there was a lot of eye-opening things that I did not know about stablecoins and CBDCs. So thank you so much for your time, Nevin. Yeah.
Likewise, thanks for having me. Let me ask you one question before we jump off, because you asked me all these questions. So, with the stablecoin rating agency idea, you are in constant contact with a lot of people in the crypto community with the show that you run. What are your thoughts on that idea? Do you think if there was a stablecoin rating website that rated the safety of different stablecoins and did analysis, would people look at it or would they not? And what are your thoughts on how best to execute that if we wanted to execute that?
Yeah. So you want this on record?
Yeah.
Okay.
Yeah.
I feel that any rating and review website bridges the gap between people wanting to get into crypto and them actually getting into crypto. I think rating and review websites are a mandate for making it easier for people to choose between what projects they should invest in, and could be of different categories. Like gaming needs to have its own rating and review website. Stablecoins need to have its own rating and review website. All the base layer protocols need to have their own rating and review websites. And the more time and effort spent into kind of making it easier, simplified, yet kind of breaking down the parameters to make it easy for people to be able to find, okay, fine, this is a stablecoin, this is the base category. But then these are the variables in which, Frax is different from UST, is different from RSR, is different from USDC, is different from USDD. And because there will be more stablecoins coming up, people want to issue more stablecoins. Giving people a platform to be able to talk about their stablecoins and also build liquidity for their own stablecoins against existing stablecoins as well. I think there is a massive need for it. And the thing with any of these rating and review sites is that it shouldn't be incentivized in any manner whatsoever. And that's where the problem comes.
Exactly.
The key thing is that people should be able to do it because they want to learn something here. And it should be, and people who put in good information should be paid in a very biased manner. Like they should mean that it doesn't need to be a decentralized system, right? Like if somebody is giving and helping people, the system should allow for editors and people who are giving out, like who are there managing the system, to pay them as a thank you rather than, you write whatever shit and people get paid for it. And that's why most social platforms sort of fail, right? But then again, if you're able to get intelligent people who understand things like yourself, who understand how currencies work, people who understand how the tokenomics work, people who understand how economics work in general, and they're able to write about, hey, like I think it is fine on these 4 aspects, but looking at it from this aspect, there is a flaw in it. Now, that is when we can possibly avoid a big Luna type situation in the future. So to answer your question, yes, I think it's a mandate. Yes, it'll make life easier for so many people. And yes, it'll make it so much easier for me to make more content. So yes, please go ahead. I am all for it.
Cool. Awesome. Thanks for your thoughts. I appreciate it.